Right, the topic for today is cost of capital. Now, if we're looking at cost of capital, we're looking at one of the key considerations in the F9 syllabus. The whole idea is this. Well, if you think about going back to the basics of F9, the principle of F9 is this. We wish to manage the financial perspective of the business. If you remember, we said on the one hand, we had the use of funds in so much as we used the funds up on non-current assets plus working capital. And we funded the business in terms of debt plus equity. And I suppose what we could say is this. If we're looking at the cost of capital, what we're saying is if we can establish the cost here, the financing cost associated with funding the business either by debt or equity, or probably a bit of both, we can then apply it when it comes to looking at any investment considerations over here. So, what do we need to know if we're looking at investment appraisal? Well, the cost of capital that we need for the investment appraisal will be some sort of average cost of capital, what we learn to call the weighted average cost of capital. But before we can get that overall measure, the WACC, what we need is the detail, the cost of capital associated with equity, the cost of capital associated with debt. So let's start at the very beginning and just think of the sort of considerations there must be when it comes to building up a cost of capital. Firstly, when we're looking at the weighted average cost of capital, let us look at the most basic, most fundamental aspect as to what determines the return that a company must offer. What I mean by that is we must consider risk in relation to return. A very simple idea, I hope. What we're talking about is this. If the investment tool is more risky, what would the investor require? More or less return? Well, most definitely they would require more return. So there is a direct relationship between those two components. Higher risk, higher return. Given that, which is more risky, debt or equity? Well, if you think about it, from the investor's perspective, debt is less risky and equity is more risky. And we'll talk about why in a moment. A principle that we want to introduce is an idea of overall return required by either the debt or the equity to the investor. As such, we could argue, first of all, that they must cover some sort of risk-free return. This is very important later when we look at something called the capital asset pricing model. But it's a very important concept at a very simple level. I suppose the suggestion is that we should be able to generate a return with no risk whatsoever. And if we can generate that return, that is the base level that all investments must offer before we assess risk. Of course, we expect all commercial forms of investment, i.e. commercial debt, a debt associated with a company, or equity, again associated with a company, we would expect them to pay more. What we would describe as a risk premium. And we'll see that this is very important from the perspective of your exam questions. Now, to look at this risk thing in slightly more detail, let's just play around with a few ideas. Firstly, risk-free return. Is it possible for you to invest risk-free? Well, the answer is probably not. It's very difficult to invest with absolutely zero risk. Having said that, we make an assumption that Treasury bills, those are short-dated government bonds, with countries should be essentially risk-free. I suppose you have to select your country with a degree of care. But we would talk about short-dated government bonds, yes, treasury bills, as being risk-free. If we were to look at risk-free return, where would you get a risk-free return? Well, of course, you're only going to get a risk-free return given that you can find some sort of investment that has absolutely zero risk. And sadly, they do not exist. However, we can get close. The suggestion is that short-dated government bonds, you know, those that will be invested over 3, 6 or 9 months, are essentially risk-free. The traditional name for them, or at least the American name for them, is the Treasury bill. And we would suggest that government bonds are risk-free. However, I suppose you have to select your government with some degree of care. So, we've got our risk-free return, our government debt. And then we could look at all other investments in relation to this. You see, we've got risk-free on the left-hand side here, and we have high-risk investments on the right. Now, hold on a moment. We're looking at basic investments here. So we're not looking at those very risky derivative ideas that are maybe bringing the whole world to its knees around 2008, 2009. But what we're looking at here is the whole gambit of basic investment products, i.e. debt investments and equity investments. That being the case, we would suggest that the ordinary share is high risk. The ordinary share is high risk for 2 basic reasons. Well, if you hold a share, do you necessarily generate a return from that share? Well, the answer is no. The dividend may be cut at any time. There is no reason for a company having to pay a dividend. It only pays a dividend if it can. Secondly, of course a share may generate a capital gain. That's great. But the problem is that the capital gain may become a capital loss. As such, if you're looking at investment in shares, there is a substantial degree of risk. Your cash return, the dividend, may or may not arise, and any capital gain could become a capital loss. Oh, finally, if we look at investment in shares, we have to remember that in the event of liquidation, shareholders are not protected in any way. In the event of liquidation of a company, the shareholders get paid out last, only after every single other party has been paid out. As such, if a company is liquidated in distress, it is likely that shareholders get paid out nothing. If we were to look at secured loan notes, well, they're typically like a debenture, if you remember that from the old terminology. But please remember, the idea or the term loan and note will be used again and again and again. Something to do, I suppose, with the movement towards international accounting standards more than anything else. A secured loan note is a debt instrument that is secured against good quality fixed assets, typically land and buildings. As such, it has some degree of risk, but relatively little. If we look at the interest paid each and every year, there is a legal obligation for each company to pay its interest. If it doesn't pay its interest, the debt holders can sue for the money. As such, the interest is a consistent amount year by year by year, normally fixed. If we look at it in terms of liquidation, if a company liquidates, the secured loan note holders are probably in a safe position, simply because of that security. The idea that in the event of the company failing, they can take the fixed asset in lieu of the money that they are owed. As such, they are likely to use very little or nothing at all. Then we look at unsecured loan notes. Now, unsecured loan notes, of course, do not have the security of fixed asset backing. Having said that, they still get a fixed rate of interest, and the underlying business is assumed to be a healthy business. From that perspective, we would expect unsecured loan notes to have a high degree of certainty, relatively little risk. Finally, just as something slightly different, and please remember you must always read up on sources of finance. I've thrown in here something called mezzanine finance. You see, mezzanine finance is where we're looking at unsecured loan notes. Fine. But not only are they unsecured, but the underlying business to which they are attached, is also risky. Maybe because of a lack of track record, or maybe poor track record in the past. As such, mezzanine finance is somewhere between the debt and the equity. High-risk debt, if you wish. So, all we're trying to suggest is this. The higher the risk, the higher the return. Very basic idea, I hope. Right, so let's look at the components when we look at our cost of capital. If we look at cost of capital, I've said to you already, our aim is to calculate something called the weighted average cost of capital, or what we just always call the WACC. This is the overall funding cost of the business, including bits of debt, bits of equity, and anything else. In order to be able to calculate the WACC, we need to calculate KE. KE being the cost of equity, the rate of return required by the shareholder. We also need to be able to calculate KD, the cost of debt, the rate of return required by the debt holder. And please note there could be more than one debt type, so you may be calculating more than one KD. We also may have to calculate KP. That's the rate of return for preference shares. A nice simple one, only a one marker. But of course, once we've got these, we bring them together to establish the overall WACC. Maybe an interesting way to think of it is this. Although we're calculating the WACC, there is no way we can even start calculating the WACC until we've got the other bits and pieces. And as such, I want you to work bit by bit through KE, KD, and maybe KP before we even get at all excited about bringing them together. With that in mind, let's start by looking at KE. Now, when we look at the cost of equity, as I've already stated here, it's the rate of return required by the shareholder. Given the level of risk of your share, the shareholder will require a return in compensation. Now, there are two basic ways of looking at this. There's the dividend valuation model, and all we look at here is the idea that, well, why are you holding a share certificate? Does the certificate itself have any intrinsic worth? Well, the answer is no. A share is only worth what it will generate into the future. And the argument with the dividend valuation model is this. The only cash return you get is the dividend each and every year into the future. As such, if we can establish the present value, the value today, associated with the future dividend income stream, you can establish the value of the share. The second method is the CAPM. Theoretically, a better methodology. This is where we look at risk. Remember, we've talked about a risk quite a lot already. The whole idea of the CAPM is we establish an overall risk level and hence return for the market. And if we know it for the market, we can then look at the relative risk and hence return of an individual share, or as we'll see later, individual project. Never mind, we'll be looking at CAPM in the future. We don't want to get too excited about it now. So, if that's the case, let's kick off by looking at the dividend valuation model. And what I want to remind you of here is simply this. If you were looking at the present value of future dividends, what we're looking at here is effectively a perpetuity. You see, a perpetuity suggests that there will be a cash flow each year forever into the future. Yeah? You see, when you hold a share, there is no expectation when you buy a share that the share will be redeemed at any point in the future. And if it's not to be redeemed in the future, we could assume that the share will generate a dividend each and every year forever. If that's the case, please remember that the present value of a perpetuity is where we divide through the cash inflow per annum by the rate of return or interest rates. And all we want to do is say this. Well, the present value of a perpetuity would give us the share price. The cash inflow per annum. Well, if we're looking at the share here, the only cash you get associated with holding a share is the dividend. And the rate of return. Well, the rate of return is the rate of return required by the shareholder. And we've already said that this is called the cost of equity. So in basic terms, this is what you need to know. Now, please note, we really should be learning this sort of basic stuff. We've got quite a large formula sheet, but please note that this is not part of the formula sheet. Having said that, at present, we're looking at calculating the cost of capital. And therefore, what we want to do is to calculate the cost of equity and not the share price. That comes later in the course. But given the formula we presently have, what we're able to do is to introduce a basic formula. PO is the share price, D is the dividend, and KE is the cost of equity. Now, cost of equity, no problem there. That's just the rate of return required by the shareholder. D, the constant dividend per annum. So that's interesting. To begin with, we're suggesting that the dividend earned will be the same each and every year. Is that likely to be the case? Well, the answer is no, but we have to start somewhere. Finally, PO. PO is the ex-div market price of the share. I didn't include there, when we say PO, we're talking at the price today, year zero. Remember, we're standing in time terms at year zero. We're told it's ex-div, and we'll have to discuss that in a moment. So all I've tried to do here is this. Given that we've got this, let's rearrange the formula. If we multiply both sides by KE and divide both sides by PO, very simply, we are able to calculate the cost of equity given the price. Okay, we've got a little example. The ordinary shares of Kewell are quoted at £5 per share ex-div. That's good. It's ex-div. We don't know what that means, but at least we've dealt with it. A dividend of 40p per share has just been paid, and there is expected to be no growth in dividends. So this shouldn't be too difficult. To calculate KE, we said that we would take, what was it, D over PO. We are told that the dividend is 40, and PO. Well, let's make sure that we write everything in pence. The example here is in pounds and pennies. Please note the example that you would get is in dollars and cents. This is not a big issue. The only thing I would say is this. Whenever I do any computation with cost of equity, I always do it in pence or cents. Strangely, when I look at the debt calculations, I tend to do them in pounds or dollars. All you have to remember is to make sure that you are consistent. You can't have a mix of dollars and cents or pounds and pennies. This is very straightforward. We end up with a KE of 8%. That is the rate of return required by the shareholder. Not exactly a problem. Well, okay, we're just starting out, but now let's go on and consider this ex-div idea. And to understand this idea, what I want to do is to just introduce a very Mickey Mouse idea to you. So let me introduce the XDiv idea to you. Let's just sketch here. If we were to sketch over time the share price. And I were to suggest to you that the share price, the underlying share price, never changes. Of course, this is highly unlikely. You would expect the share price to bounce around a bit, wouldn't you? But I'm just suggesting this to illustrate what's going on. If the underlying share price never changed, my question to you is this. Why would you expect the share price to rise during the year, only to fall back? Rise during the following year, only to fall back. Rise during the following year, only to fall back. And so on and so forth. Why would you expect this to happen regular as clockwork? Well, yes. Couldn't you say something like this? You would expect the share price to rise in anticipation of a dividend being paid. Just before a dividend is paid, we describe the share as being cumdiv, or cumulative of dividend. Immediately after the dividend has been paid, we describe the share as being ex-div. Now, as I have said already, we want to illustrate everything ex-div. What's the difference between cum and ex? Well, yes, the dividend to be paid, as simple as that. So this isn't rocket science at all, but it's just something that we have to remember. So let's look at example 2. The ordinary shares of Gerard Limited are quoted at £2 per share. Easy peasy lemon squeezy. A dividend of 15p is about to be paid. Oh, about, in the future rather than the past. And there is expected to be no growth in dividends. Well, okay, I don't think this is going to be too difficult at all. All we have to do is to take the information and bang it into our answer. So if we're looking at example 2, we said KE equals D over PO. D, we know, is 15p, because when we're talking about dividend, we're talking about the dividend yesterday, today, tomorrow, somewhere around now. And we divide through by the price. Well, the price is 200p. But remember, because the dividend is about to be paid, we would describe that as cum div. To get it ex-div, we take away one dividend. Once we've done that, we multiply by 100, and hey presto abracadabra, we get something like 8.1%. So, looking at basic dividend valuation model, it is very straightforward indeed. Please note, any of these computations is going to have a very small mark allocation. So what could the examiner do to make life a little bit more exciting? Well, one of the big weaknesses so far is that we're assuming that the dividend does not change. And of course, you know that the dividend will change. In fact, in the real world, the dividend may go up a bit and down a bit, but that's too complicated for you and I. So the sort of thing that we tend to get is where there is a constant growth rate in the dividend. So let's look at it. If we were to look at the formula for growth, all we find is that we have played around with the formula that we have already got. We've incorporated growth into what we already had. Now, looking at the formula that I've highlighted, KE equals D1. Well, what does D1 mean? We're standing at year 0. We're calculating P0, that is the price at year 0. But remember, we've said that we're calculating everything ex-div. And that means that the first dividend that we expect to get will be in 1 year's time. So D1 is the dividend in 1 year. We divide by P0, the price, and we add G. Well, G is very straightforwardly the growth rate. If you want to, we could revise things slightly. It's a very simple idea. What we've done here is instead of taking D1, the dividend in 1 year, we've just described it in a slightly different way. The dividend in 1 year will be the same as the dividend today plus 1 period of growth, DO1 plus G. I must say, I like to remember the first formula. The reason being is that if you have a more general question, it reminds you that the first dividend we expect is in 1 year. And that is quite important if we're looking at any form of delayed dividend. Having said that, for the vast majority of the questions, having it laid out so we know DO1 plus G may be useful. Oh, very importantly, you're not told this by the examiner. You have to learn this. So learn one or the other, or if you're really crazy, learn them both. So, if we introduce growth, this is the way we go about it. Let's see how it works. Alonso Limited has a share price of £4 ex-div. Right, well that makes one thing easier, doesn't it? Ex-div is the way that we want the information. And has recently paid out a dividend of 20p. Dividends are expected to grow at an annual rate of 5%. What is the cost of equity? Well, okay. I reckon we can probably slot it in here. We said, what was it? KE equals D1 over PO all plus G. What is D1? Well, D1 is the dividend in 1 year's time. If it's the dividend in 1 year's time, the only way we can calculate that is by taking the dividend today, 20p, and multiply by 1 plus the growth rate, 1.05. You know the dividend today plus 1 period of growth gives us the value in 1 year's time. We divide through by PO, 400p. Please note, you've got to be consistent here. If you're not consistent, it will all go horribly wrong somewhere, won't it? Yes? And given that we have that, all we have to do is to add G. Add G, well that's 5%. So, is this too difficult? Well, I've got a sneaking suspicion that it comes to 10.25%. Please remember, the mark allocation for this is not going to be ginormous. But the flip side is that you must know it, because this is something that will come up more often than not in the exam, and, well, it's the bread and butter marks of getting through this paper. So, we've established how to deal with growth. But please remember, your examiner does not leave it there. What your examiner does is he requires you to calculate the growth rate. There are two main methods of determining growth, and the first method is something called the average method. Well, I'll tell you what, rather than playing around with this highly sophisticated formula, shall we just briefly go away and understand where this may come from? Let's just look at a Mickey Mouse example. Let's say I was given this sort of information. If we're looking at our dividends, I was given a dividend today, presumably relating to last year, of 10 pence. I was also given a dividend for 3 years ago of 7 pence. I suppose what I'm suggesting is simply this. I've got a dividend today, and I've got a dividend so much less 3 years ago. Of course, there'll be some growth between those two. So we're taking the growth in the dividend in the past and we are extrapolating it into the future. So how do we do that? Well, couldn't you say that we're looking at compound growth here? And if we were looking at compound growth, we know this sort of thing. We know that the future value equals the present value multiplied by 1 plus r to the power n. Do you remember that rubbish? Well, okay, so what have we got here? Well, it is slightly odd because if you think about it, we're going to take today's value, that's the one more in the future, and the value for 3 years ago, that's the one more in the past. Couldn't we say something like this? That the future value is 10p equals the present value 7p. Can you see the relationship there? Multiplied by 1 plus r. Well, what is r? What is the return here? I suppose the return is the growth rate, what we're trying to calculate. And n is the number of compounding periods, 3. So I suppose what we're saying is this. If we can rearrange the formula, we'll be able to calculate this growth rate that much more easily. So, how do we do that? Well, presumably, we could say something like this. 10 over 7 equals 1 plus g to the power 3. Or 10 over 7, we've got to take the power 3 across, haven't we? We need the cube root to give us g. Yes? Or if we tidy it up completely, g equals the cube root of 10 over 7 minus 1. Something like that. Well, okay. In order that we remember it, rather than have to rearrange it each time, all I've done is given you a formula. And that's precisely the formula that we have here. I must say, I've given you this formula, the nth root of dO over dn minus 1, because I felt it would be easier for you. But I've seen many people struggle with their calculators to get this sort of thing right. So what we could do is make it slightly easier to put it into our calculators. Instead of talking about the nth root that a lot of people get wrong, couldn't we simply say this? dO over dn to the power 1 over n minus 1. Mathematically, it means the same thing. It's just simpler to put into our calculators. So let's just take this very simple formula and shovel the numbers straight back in. If we're going to say g equals dO over dn to the power 1 over n minus 1. dO. Well, dO is the current dividend, 10, divided through by dn, the dividend n periods ago, 7, to the power 1 over 3 minus 1. I hope everybody's able to calculate this. In your calculator, I know I'm insulting your intelligence. But 10 divided by 7 equals. Then, well, modern calculators, you tend to have x to the splot if it's a Casio, or if it's a slightly older calculator, the one I like, to the power sign, something like that. Older still, you may get x to the y, and older still, you may get y to the x. But whatever happens, you should find somewhere to the power something like that. Now, I want to the power 1/3. You could put 0.3333, but if you do that, you may not get it absolutely accurate. So what I do is I open the brackets. The brackets being normally on your calculator just above the numbers. 1 divided by 3, close brackets, equals. -1 equals. And I think if you do that, you get somewhere in the ballpark region of 12.6%. Yeah? Somewhere there or thereabouts. Make sure you can do it. Let's go back and see how we may apply this in larger questions. Please remember, this has to be remembered. Nobody's going to remember it for you. It's certainly not given in your formula sheet. Okay, let's take this and play with larger questions. Example 4. Sissoko paid a dividend of 20 pence per share 4 years ago. Oh, okay, we know where this is going. And the current dividend is 33 pence. The current share price is £6 ex-div. Oh, okay. So first of all, let's estimate the rate of growth in dividends, and secondly, calculate the cost of equity. Well, it's all about presenting the information correctly. Shouldn't be at all difficult here. What do we say? We said that G equals dO over dN to the power 1 over n minus 1. If that's the case, dO, do we have that? Well, most definitely yes. The current dividend is 33. dN, 20. To the power 1 over n, 1 over 4 minus 1. So, all we have to do is to bang the numbers into our formula. If we do so, I seem to remember that this comes to something like 13.33%. If you want to, you don't have to write it like that. It comes out of your calculator in this manner, 0.1333. And maybe that's how you want to leave it, because, of course, you're going to bang it straight into the next formula. Well, okay, so we've got that far, and now what we can do is to establish calculate KE. Now, I've said to you, KE equals D1 over PO all plus G. Of course, if we write it this way, we have to remember that D1 is in 1 year's time. And because of that, what? Well, most definitely, what we have to remember to do is to add 1 period of growth to it. D1 is going to be DO, and we said that that was 33, didn't we? Multiplied by 1 plus G. 1 plus the growth rate, 1.1333. Divided through by P0. Well, P0 is the current price, and the current price is £6 or 600 pence. Remember, we must be consistent. And finally, we add G. So I'm hoping that this is not too difficult. Remember, the deal is you learn the formulae, and in the exam, the only thing you're focusing on is where do I get G from? Where do I get D0 from? Where is P0? If you can do that, there's going to be no real problem with getting the overall result out. So we've got all the numbers in, shove them into your calculator, no problem here. We get something like 19.56%. Well, okay, let's just have a Mickey Mouse calculation to make sure that we can all do this. Mascherano paid a dividend of 6 pence per share 8 years ago, and the current dividend is 11 pence. The current share price is 258 pence, £2.58, ex-div. If we want the cost of equity, let's go it bit by bit. G equals DO over DN to the power 1 over n minus 1 DO, 11. DN6 to the power 1 over 8 minus 1. You know how to do this. Make sure that you can slot it into your calculator properly. 11 divided by 6, take it to the power. Open the brackets. Close the brackets, equals minus 1. And what do we get? Well, I get something like this, 0.0787. Once we've got that growth rate, slap it straight into the formula. KE equals D1. D1 over PO all plus G. D1 is the dividend in 1 year's time. The dividend in 1 year's time is going to be the current dividend, which we have, 11, multiplied by 1 plus the growth rate, which we have, 1.0787, divided through by PO. Well, if we're looking at PO, we have it up the top there, but remember, we have to express it in pence rather than pounds. Pence rather than pounds, cents rather than dollars. Then we add the growth rate, 0.0787, and hey presto abracadabra, what do we get? Well, we get something like 12.5%, maybe slightly less. So, you have to be able to do these calculations without thinking. You must know your formulae, and you must be able to run through the calculations extremely quickly without error. The mark allocation, as I've said, is not great. But this is the bread and butter stuff. This is what you must do as a foundation to do well in this paper. A little bit more for us to do before we leave this area. There is an alternative way to calculate growth. Gordon's growth estimate. And it comes up with a very straightforward formula. G equals RB. Or, if you want to, what the examiner does is he gives you this. He actually says BRE. I like RB because it reminds me of rhythm and blues. And if I say rhythm and blues, I always remember what it's all about. But if you want to rely on what the examiner is giving you, remember, this is given in the formula sheet. You must know your formula sheet from top to bottom. Okay. So, what does R mean? What does B mean? Well, when we look at Gordon's growth model, it's a very basic idea. Some would say it's very weak, and we'll talk about possibly why Gordon's growth model could be criticised. But what we tend to find is that the model itself is often a very good approximation of growth. But let's first of all see what it tries to show. You see, firstly, Gordon suggests that to grow, a company must generate some funds. So therefore, there must be a measure of return. That is R. Now, if we were to be slightly more pedantic, we're looking at a return in relation to equity. And as such, we would expect a return on equity measure. Please note, however, that in the past, the examiner has used other measures, not necessarily ROE. But this is what we're expecting. We take ROE, which is what? Profit after tax divided through by equity. So, for a company to grow, it must generate a return. No problem there. Given that it generates a return, then we can look at B and simply say this. Not only must a company generate return, but it must also reinvest some of that back in the business. If all of the return was taken out in the form of dividend, then the company would not grow. So all we're talking about with the second element is the proportion retained or reinvested. And maybe we could talk about retained earnings divided through by profit after tax. Now, the issue is this. You could say Gordon's growth model is rubbish because it focuses on profit, which is subjective at very best. And also it focuses on a single year. And of course, that single year may be different or atypical to all other years, either before or after. But what we tend to find is that in practice, it's a very solid, rough and ready measure. The reason being this. There is a balance between the proportion retained, you know, this B element here, and the dividends upon which the dividend valuation model works. Because if you retain more, you necessarily pay out less in the form of dividend, or vice versa. So in practice, it has been shown to be quite a useful guesstimator. Well, okay, we've got a Mickey Mouse example here. Let's see what's going on. The ordinary shares of Torres Limited are quoted at £5 cum div. I thought I wouldn't catch you out. Notice it's cum div, cumulative of dividend. What does that mean? Well, exactly right. It means that the dividend has not yet been paid. We want to use the ex-div value. In order to do that, we're going to have to strip out of the dividend from this value. Good one. A dividend of 40 pence is just about to be paid. Oh, okay, so if we didn't pick it up first time, we were given a second bite at the cherry. The company has an annual accounting rate of return of 12%. And each year pays out 30% of its profits after tax as dividends. And we've got a very simple requirement here. Estimate the cost of equity. Well, okay. Let's look at the growth rate first of all. G equals RB, rhythm and blues. What is R? Well, I've said to you that we want a return on equity, profit after tax divided by equity, but we're not always given it. Here, with the limited information, we're given some sort of annual accounting rate of return. In the absence of anything else, that is what we would have to use, 12% or 0.12. Then we want to look at the proportion retained. And what we're told is that each year we pay out 30%. If that's the case, the proportion retained will be the other bit. I know it's obvious, but please make sure you get it right. This is the sort of thing that people get wrong every time. The proportion retained will be 1 minus the payout. If 30% is paid out in the form of dividend, the other bit, in this case 70%, will be retained. So what we end up with is a growth rate of 8.4%. Or, if you want to, you could have written it 0.084. No problem with that. So now let's slot it back into the formula. KE equals D1 over PO all plus G. What is D1? Well, if we're looking at D1, we have somewhere the current dividend, 40 pence. And what we want is dividend in 1 year's time. So we multiply by 1.084. Dividing through by PO. Well, we know that PO up top is 500 pence. I know, I'm not going to pull the wool over your eyes. 500 pence was cum div. And of course, what we want is an ex-div value. So if we take away the dividend of 40 pence from that, hey presto, we've got the number that we need. We're then able to add the growth rate, 0.084. Have a go. See what you can do. Okay, so what we've been able to do is to establish the dividend valuation model, how it works. And therefore, critically, we can establish the cost of equity dependent on the dividend stream into the future. The alternative to looking at the dividend valuation model is to look at something called the CAPM. If we're looking at the CAPM, or the capital asset pricing model, the basic deal is this. We know that there is a relationship between risk and return, and therefore we can use this relationship of risk and return to value a share. Well, that's fine. The great thing about this is that we can set up a very simple model that allows us to value any share providing we know the relative degree of risk. So before we get into any detail, because there is quite a lot of background associated with CAPM, that's the one thing I want to focus on. The CAPM, a measure of return in relation to relative risk to the market as a whole. I always think it's important that we have some basic framework in mind. So if we can get the risk-return relationship for the market, then all we need to do is to understand how an individual share relates to that market. Oh, not too difficult at all. Now, if that's the case, there are a number of things that we're going to have to discuss. Firstly, we're going to have to discuss something called portfolio theory. Not a difficult idea, but it underpins a lot of what we're discussing here. Secondly, we have to talk about distinguishing between what is described as systematic risk and unsystematic risk. And once we've got those basic ideas, all we're going to do is end up with the CAPM formula. And we'll see that that is incredibly straightforward. One thing I want to highlight is this. Your examiner is very keen to examine this area. And that is evidenced by the fact that there are 3 articles that you can access on the ACCA Global website between January 2008 and August 2008. My suggestion is that you simply have to search this. Tony Head, that's the examiner's name if you didn't know it already, F9 and CAPM articles. If you put that information into the top right-hand corner of the ACCA website where it says search, very quickly indeed you can pick up those articles. And that must be important. Remember, if you can tell the examiner what the examiner has tried to tell you, you must be picking up marks.